In today's video, we will cover the four major mutual companies and their 2023 dividend interest rates that will be applied to whole life insurance policies. So we'll cover the updated dividend rates and then a whole lot more. So let's get on into it and have some fun. Beginning with our four major mutual companies, we have Mass Mutual, Guardian, New York Life, and Northwestern Mutual in no particular order. So kicking off with the 2023 dividend interest rates, here's what we have. Mass Mutual at 6%, Guardian at 5.75%, New York Life at 5.8%, and then Northwestern Mutual at 5% flat. Now to the right of the 2023 dividend interest rates, we see what the dividend interest rates were in 2022. So what you'll see is that all, with the exception of one of the major mutual companies, maintained the exact same dividend rate that we saw in 2022. No change. Guardian, on the other hand, did have a slight increase. We see 0.1%. So their total dividend interest rate is 5.75%. Now, dividend interest rates are very important when we look at whole life insurance policies. However, anytime we see a dividend interest rate on a whole life insurance policy, is that what our policy is actually growing by? For example, if you have a policy with Mass Mutual, let's say you've got $100,000 in cash value, and you see a 6% dividend interest rate, does that mean you would receive $6,000 in earnings? Because 6% of $100,000 is $6,000. The answer is no. And the reason why is because anytime we see a dividend interest rate, we always want to remember that that is a gross rate that is applied to your policy after the insurance company assesses their insurance expenses, mortality charges, and everything that comes with the actual life insurance policy. What we want to look for is the net internal rate of return. What is the cash value actually growing by? So our company, what we specialize in is whole life insurance products specifically designed for maximum cash value. That's what we do. Maximize the upfront cash value, maximize the long-term cash value, and then work with our clients throughout the life of the policy, meaning as long as they have that policy, and really helping them use the policy. What does it look like when we want to take out loans and pay them back or don't pay them back, and everything that comes with the product that we've got a lot of content on. However, we have stated many times over the years that we recommend the four major mutual companies, which are Mass, Guardian, New York Life, and Northwestern Mutual. The reason why, well, there's a number of reasons. I'm going to go through three of the main reasons next. So why do we recommend the big four? Number one, this is the biggest one in my opinion, and we're going to provide more information on this shortly. Proof of performance, cash value, internal rates of return. The internal rate of return is your net growth rate on cash value, specifically on whole life insurance products. This is the number one reason, and again, proof of performance is what I am so big on, not just what do the numbers show on an illustration. Number two, where the money goes. So another way to put this is follow the money. Copy what the wealthy are doing. When I look at banks positioning boatloads of money into cash value life insurance products, and then analyzing the companies that they're selecting, often we'll see the four major mutual companies selected first. Typically, you'll see Mass Mutual and New York Life. They've been 1 and 2 for a long period of time. Northwestern Mutual has a very attractive BOLI product. However, Northwestern Mutual is a company that only works with career agents, meaning as an independent broker, we cannot offer their products. However, they have a fantastic BOLI product. And then when you look at Guardian, Guardian is in the BOLI market. However, they work more so with community banks, smaller banks. However, their product is very attractive. And bank-owned life insurance is different than whole life. My point is, however, when you look at what banks are doing with their cash value life insurance purchases, we see them often select the major mutual companies and other companies as well. However, you'll often see the big four at the top of the list. Corporations. So when you look at what corporations are doing and want to copy them, meaning if a corporation is taking out a number of whole life insurance policies on their executives, positioning the cash values as an asset on the corporation's balance sheet and setting up an executive benefit plan, what companies are they actually using? You'll frequently see the four major mutual companies. And then the wealthy, when it comes to individual policies, who are they often using? When it comes specifically to whole life insurance products, we'll see the four major mutual carriers. And the reason why, because if I'm a consumer and someone's telling me this, that the four major mutual companies are often the preference of wealthy individuals, corporations and such, I would ask why. Like, why are they going to those companies when there are a lot of other life insurance carriers out there? And the reasons why, there's a number of them. We've got their financial ratings, cream of the crop. If we were to look at their Comdex score, which really takes the different rating carriers and almost gives a grade, you'd see each of these four companies range between a 98 and 100. 100 obviously being the highest. So cream of the crop when we look at their ratings. When we look at their financial strength, size, strong as can be. They're also massive. When we look at their age, how long they've been in business, they've all been in business for over 160 years. So that's a long time. However, to really button up that answer, why the four major mutual companies, I like the points under number 3. However, the point under number 1, that's the most important piece to me. Because if a company has phenomenal ratings and they're massive in terms of their size, but they don't have any proof of performance, or they've always delivered weak cash value returns to policyholders, I might not want a policy with that company. So, on the topic of proof of performance, actual performance on whole life insurance policies. If you're going to take notes or take away one thing from this video, aside from the updated dividend rates, this would be it. And this will help avoid buyer's remorse. So the biggest source of buyer's remorse that occurs when it comes to whole life insurance policy sales, when cash value specifically is the goal of the consumer, is often one takes out a policy, they see what is shown on an illustration, and they're often told by the agent, you should see values similar to what this illustration displays. If it's several years ago, the IRR may have been over 5%. But then that policy underdelivers, meaning you took that whole life insurance policy out expecting to have a strong internal rate of return, call it 5%. But then the actual performance ended up being 2%, maybe 3%. That right there is where an individual feels like the reason I took this policy out is because I thought I would have $1 million, but I only ended up with $600,000. Why did this happen? Or why was I not told this could have been possible by my agent up front? And then there's a million reasons as to why. That's a whole nother story. My point, however, is when we look at buyer's remorse, what I just explained there is often expressed by individuals. They got into the product and found out after the fact that it wasn't what they thought it was. So what we've seen when we look at the actual data, this also mimics the corporate model, what corporations do when selecting whole life insurance products, is looking at some historical performance, meaning real policies that have lived the test of time. And what I've seen to be consistent is when a whole life insurance policy is taken out with one of your four major mutual companies, and then 2, properly designed, meaning for very, very high cash value, particularly on the guarantees, when that's maximized, that's where we see strong cash values, particularly based on actual results, not just illustrated results. So historically, when we look at policies that were issued in the 1980s and 90s and even early 2000s, we see that 4 to 6% internal rate of return on cash value. And we've got our historical case study series, which goes through policies that were issued. The oldest one we have is 1975, and then policies that were issued, meaning started in the 1980s, 90s, and then post-2000. But based on historical performance, we've seen ranges between 4 to 6%. However, to set expectations properly, if I'm starting a policy today, I would expect the net internal rate of return to fall somewhere in this neighborhood, somewhere between 3 to 5%. Could be a little bit better if interest rates continue to climb and then remain high for a long period of time. Often what you'll see with respect to dividend interest rates is if the interest rate environment experiences an increase like it did back in the 1980s, eventually dividends will follow, where we see dividends rise. On the flip side, when we look at post-2008 and interest rates bottomed out for a long period of time, dividend interest rates did the same. They followed the interest rate environment. So to set expectations properly and just looking at where we're at right now with respect to the interest rate environment and assets that are available for insurance companies to purchase, I would expect the net IRR on a whole life insurance policy to fall somewhere between 3 to 5%. And of course, we always want to look at the guaranteed values, the non-guaranteed values, so we've got full transparency on what it could be, especially the guarantees with a worst case scenario. But based on everything we've always seen, that is where I would set expectations, and I'm comfortable when I look at my policies expecting that. So that is some actual performance data. That's the biggest selling point. Properly designed policies with the major mutual companies is when we've seen satisfied policyholders based on real results. And then to wrap it up, so how do you choose the right company for you? Because we've got 4 companies here, and you might still consider smaller companies. There's nothing wrong with smaller companies at all, especially if you're able to obtain proof of performance from them. However, if you're looking at the 4 major mutual companies and prefer them, how do you choose? Because I can take one company and show you 8 different whole life insurance products, which is a lot. So how do I select the right company? Here is the biggest factor that often refines an individual's decision-making process. This word right here, flexibility. Specifically, how do I take a high cash value life insurance policy? When I look at the cash value, you've got those core benefits: safe, liquid, tax-free. Tax-free if we don't trigger a taxable event, such as a MEC, of course. But when I have those, how do I take this product and use it as a flexible savings asset, not a boring insurance bill? An example, I want to be able to fund $100,000 per year. However, Steve, I don't want a bill for $100,000 per year. So this right here is often step 1 in helping an individual refine their decision-making process. Let's go through a quick example. This is you. You want to be able to pay in $100,000 per year. We can design a policy with each of those companies where you've got a minimum premium of about $10,000 per year. And what that means is we can throw everything else into your PUA rider, which is how we are going to accelerate the cash value growth. And that $10,000, we'll assume for this example, is covering your term rider as well. So when we look at the fundamentals to policy design, if we want to be able to stuff money into our PUA rider, we will need a term insurance rider to prevent the MEC, taxable event. But if this is you, can you have a design like this with any of the companies? Yes, some companies allow you to go a little bit lower than 10% on the minimum premium. Some will force a design that has a little bit higher base premium. But you can get a minimum premium with each of those companies. High upfront cash values, breaking even typically between 3 to 5 years, sometimes 4 to 6 years. But you can accomplish a high cash value policy is my point. What about this part though? Flexibility. So here's the big difference, to give you 2 examples here. Guardian is extremely flexible. Guardian is a company that if you have this design, you can commit to the minimum premium only. So call it $10,000 per year. So you can pay that annually. You can pay it over 12 months. You can pay the minimum however you want. And then 100% at your leisure, when it comes to adding money into PUA payments, you can just throw them into the policy. You can do this through your online portal, your mobile app. You could even mail in a check if you like to do it old school. But my point is extremely flexible. However, to provide some additional awareness, to really hit the sweet spot with a Guardian policy, max funding it for 10 years or less, meaning if I want the ability to pay in $100,000 per year, if I wanted to max fund it for 10 years, perhaps it's less, but then nothing thereafter, or maybe pay just the minimum premium, that's really how you can maximize a Guardian policy. However, if you said, I want to be able to pay in $100,000 per year, but I want to do it for as long as possible. 30 years, let's call it. And I'm 40 years old now, so up until I'm 70. If that's the case, you can do it with Guardian, but it will be a challenge. What I recommend in this case is MassMutual. Because from a company and product limitation standpoint, we can design a policy with a $10,000 minimum premium, funneling $90,000 toward PUAs. There's my total of $100K per year. Can do it for 30 years. Don't have to worry about a MEC, a taxable event, anything like that. And you can continue to feed the beast. I like that saying. However, the item to be aware of with MassMutual is it's not like Guardian where I can just commit to the minimum and pour in excess funds into PUAs whenever I want. From an awareness standpoint, if it's properly designed with the right riders, we can easily make payment adjustments one time per year, every year, provided that adjustment is made on your premium due date. So for example, I could pay in $100K in the first year, then the next year when the premium comes due, I'm billed for $100K, but I say, hey, $100K is not going to work this year. Let me scale it down to 50. Maybe I pay 50 per year for the next 10 years. Then I want to scale it back up again. I can do that provided the adjustment occur on that premium due date. That's your policy anniversary date. And all companies have different rules and such, which we do have some content that goes over that. And if you're working with us, we'll certainly provide that information as well. But I hope that was helpful in terms of the updated dividend rates and then some additional information as well. If you did enjoy it, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.